Look at your screens right now, because what you are witnessing is not noise. It is not speculation. It is not another temporary headline spike that fades by next week. What you're seeing is the exact moment the global financial architecture begins shifting from theoretical fragility into undeniable, measurable stress. Over the weekend, the geopolitical situation in the Middle East did not merely intensify. It fractured key assumptions that global supply chains have relied on for decades. And when those assumptions fracture, pricing models across the commodity complex begin to break. Silver is not moving randomly. It is testing structural boundaries for a reason. Mainstream financial media will tell you this is a short-term fear trade. They will call it a classic flight to safety. They will insist it will fade the moment a diplomatic microphone appears on a podium. But beneath the headlines, the deeper mechanisms are already in motion. Maritime insurance costs are rising. Physical delivery requests are accelerating. Futures positioning is becoming unstable. These are not emotional indicators. These are mechanical ones. Welcome back. This is John O.G., and today we are breaking this down without theatrics, without fear, and without fantasy. Always. Nothing here is financial advice. This channel exists for one purpose: financial awareness. We examine macro structure, liquidity behavior, and systemic pressure points so you can interpret the landscape clearly. Now let's focus on what actually shifted. When maritime corridors like the Strait of Hormuz face elevated risk, global trade does not wait for official declarations. Risk is repriced instantly. Insurance premiums climb, shipping routes extend, fuel costs rise, delivery timelines stretch, and in a just-in-time industrial system, delays translate directly into production stress. Silver sits in a unique position within that system. It is not merely a monetary metal. It is embedded in solar infrastructure, electric vehicle systems, advanced electronics, defense components, and expanding data architecture. Industrial demand is not optional. It is structural. Manufacturers cannot simply replace silver in high-performance applications without compromising function. When logistics tighten and physical supply becomes uncertain, procurement behavior changes. Buyers prioritize certainty over price. That shift matters more than any single chart pattern. Now let's address the $100 threshold. For decades, round number price levels in commodities have acted as psychological barriers. Large institutional participants often cluster positioning around these levels. Short exposure can accumulate there based on the assumption that historical ceilings will hold. But markets evolve. Liquidity environments change. And when positioning becomes crowded, vulnerability increases. If upward momentum intersects with heavy short exposure, volatility expands. Automated systems that manage risk may be forced to adjust, can create accelerated price movement, not because of conspiracy, but because of structure. In leveraged markets, repositioning can be swift. There's also the concept of liquidity gaps. When a market has spent extended periods trading within lower ranges, historical transaction above those ranges may be thinner. That does not guarantee rapid movement, but it can allow for it if momentum and positioning align. However, elevated volatility cuts both ways. If silver approaches major psychological levels, you should expect turbulence, sharp intraday swings, rapid reversals, narrative shifts in media tone. These are normal features of stressed markets. Emotional decision-making during such periods tends to benefit liquidity providers more than participants reacting impulsively. So how should this be framed? Focus on fundamentals, not noise. Has global supply materially expanded overnight? Have logistical bottlenecks instantly resolved? Has industrial demand structurally declined? If the macro thesis remains intact, short-term volatility does not automatically invalidate it. At the same time, disciplined analysis matters. Commodity markets are complex. They respond to currency strength, interest rate expectations, industrial cycles, geopolitical developments, and investor flows. No single catalyst determines long-term direction in isolation. We are operating in an era defined by higher geopolitical fragmentation, rising fiscal pressure, and increasing infrastructure demand. In such an environment, hard assets often re-enter strategic conversations. Silver's dual role, monetary history and industrial necessity, places it at an interesting intersection of those themes, but conviction should be built on data, not adrenaline. Watch shipping flows, monitor industrial demand reports, observe futures positioning shifts, track inventory changes, evaluate currency strength and bond market signals. These factors provide clarity. Headlines alone do not. If silver approaches or exceeds significant price thresholds, avoid assuming either euphoria or collapse is inevitable. Markets often overshoot, retrace, consolidate, and then redefine equilibrium. Patience is a strategic advantage. The broader takeaway is this: we are in a period where structural assumptions are being tested globally. Supply chains, energy corridors, fiscal policy frameworks, none are as stable as they once appeared. Assets tied to tangible utility naturally draw attention during such transitions. But transitions unfold over time. Stay analytical, stay measured. Avoid binary thinking. recognize volatility without being controlled by it. And most importantly, separate narrative from mechanism. This is John O.G. Keep your perspective grounded in structure, not emotion. Markets reward clarity and discipline far more consistently than they reward excitement.